In this video, guys, I want to talk about avoiding choppy markets. Stay tuned. Hey traders, warm welcome to you. All right, so chop is an absolute P&L killer. We can't avoid it. It's the way it is. And I define chop as basically directionless movement. Now, to me, that's slightly different to volatility. Well, it's very different to volatility. Volatility is when things are moving, things are a little bit more predictable. So you're moving, you're getting flags, getting momentum ignitions, getting exhaustions, lots of opportunities to get your teeth stuck into. Whereas chop to me is when we have an environment that is just kind of bursts of volatility, calming down, bursts of volatility. Very difficult to trade choppy environments because there's no real direction. At the end of the day, not necessarily direction in one trend, because we can have mean reverting volatile markets that offer opportunity as well. But really our job is to try to predict ultimately where price is going to go in the next X minutes if you're a day trader, X days if you're a swing trader. And our job is to find conditions which we think are a precursor for a movement in one direction. Why we talk about setups and why we talk about technical patterns. The flag, a great example. Big drive, hold at highs. Our thesis when we trade the flag is that that is a precursor for an additional move. It's a momentum move. The balance is tipped. Supply-demand balance is tipped. Bit of a tongue twister. In one direction, we pause and we're going to continue. And that's the thesis of it. So our job as traders is to find these patterns that are a little bit of a signal, as potentially a clue as to where the next direction is going to be. That's the job, right? As a trader, that's simple as that. Maybe from a technical trader, maybe different, you're fundamental, but you guys are a technical trader. I know you're a technical trader. So when we're in choppy markets and choppy environment, we have this unusual, uncomfortable situation where we're trying to decipher what's happening, and really there's not really a precursor or any clue where price is going to go. And the thing is, guys, most of us are quite good at avoiding chop most of the time. Can get sucked into it. We can kind of get caught up in all the little nuances and movements and get involved, but most of the time we're okay with chop. The challenge is when chop goes to a decent market and back to chop, decent market back to chop, decent market back to chop. So a good way of kind of avoiding chop is to use, to be honest, guys, the best thing is just to use your eyes. I'm going to show you some indicators and stuff to help frame this, but honestly, just being objective. And if you've been in this business more than 6 months, right, which most of you guys have, I know you have, you're going to know what a choppy market looks like. I can show you a chart and say, hey, here's the chart, that's chop. And you're going to go, yeah, that is chop. Here's a chart, is that trending? Yeah, it's trending. Here's a chart, what is it? It looks choppy. You objectively know, when you're looking at the cold light of day, exactly what's happening. You know what it is. It's just chop. So that's number one, guys. Just use your eyeball and just be very objective to it, and don't give in to the little voice that's saying, yeah, but you're going to miss a trade. You should be on this. You're going to do this. You're going to do that. No. It's chop. I don't have any edge here. I'm going to keep my hard-earned capital well and truly tucked up in my trading account. I will not trade it. And that's exactly what you say to yourself. Okay, so let's hit the screens and show you a couple of ways and tools potentially of dealing with chop. All right. So I've got here a 5-minute USD JPY chart. Now, again, it could be anything, really. It could be anything. One of the primary ways to think about dealing with chop is to look at just the range. So I've just got on an average true range here, histogram, colored yellow, down at the bottom. And you can literally say to yourself, right, I am not even going to get involved in the market unless we get above a 30-tick ATR, 30-point ATR. And you can trade like that. Now, the downside is you might miss little breakouts like this, but the point is we don't want to be jumping on the first little sign of volatility. We want to see continued rise of range. Now, that might not be enough. But if you're combining it with key levels, you combine it with this, it might be that just keeps you in the zone. It keeps you out of trouble. If we go to like a SPY daily chart, recently, for example, we've had one of the lowest ATRs for a while. Average true range. By the way, I've just got this on a setting of 14. It could be anything. 10, 20, whatever you want to do it. The point is just acting like a filter. And you might say, you know what, I'm not going to get involved until we get above $4 again. That's where my sweet spot is. And it might not be for one specific instrument. It might be if you're trading stocks, you're trading currencies, a basket of markets, that those have specific ATRs where you look to get involved in. So it could be intraday, it could be on a swing trading basis, it could even be on a daily chart. You say, hey, I will day trade these vehicles or these markets if the daily ATR gets above X, because I know that's going to filter down or trickle down, should I say, into the lower time frames. So you could even do that if you've got a basket of stocks you're watching, same type of thing. So ATR is a great way of doing it. Another way of doing it, guys, is, and I'm not a huge fan of this, but I want to share everything with you, because at the end of the day, just because I don't like it doesn't mean it doesn't work for you, right? So I try and share everything. The other one is if the Bollinger Bands are expanding or contracting. Now, when Bollinger Bands start to contract, and there is an indicator out there that's got a Bollinger Band width. In fact, if we see if we can find out, I don't think I've ever used it on TradingView. Let's have a look at Bobby. Bollinger Band width. There you go, Bollinger Band's widths. So you don't even have to eyeball the Bollinger Band. It is done for you. Let's just dump ATR. So it's down here. So when that width is lower, it means that basically the movement is less. The standard deviation bands, which the Bollinger Bands are, you've got a moving average, the standard deviation bands are wrapped around it, normally set at 2. I think I've got these ones set at 2. I think that's the default normally, 2. You can have them 3, which is wider, but you get the idea. I'm sure you can change that setting as well on your Bollinger Band width. Yeah, 20 and 2. So it's going to give you exactly the same thing, because the width is probably going to be the same between the lowest standard deviation on second standard deviation or third standard deviation. Anyway, the point is, guys, the width of the Bollinger Bands is not a bad way of getting involved. As you can see, wide Bollinger Bands, if you're using the Bollinger Band width type thing, it starts to show more volatility. Now, there is a slight issue with this, is that these don't account for trending environments. So the range could be narrow, the Bollinger Band width could be narrow as well, but you could be trending. So you've got to then think, well, maybe do I use an ADX, which is a trending environment, or something like that. Another one, a last one I'll put for you guys as a kind of filter. And by the way, it's up to you to decide how to use these. If your objective is to stop getting chopped up over trading in, and he said bad word then on YouTube, and poor environment, by the way. Anyway, if you have a filter that you can put a filter in place, so you're trying to avoid specific chop, then it's well worth doing. It's well worth being strict with, because why are you undoing all the hard work on over trading in poor environments? So again, if we use something like the rate of change is not a bad little tool to use to give you an indication of how things are kind of moving, because you might have a quiet environment where the width is low, but ultimately if the rate of change has gone quite high or quite low, that might indicate a good kind of movement, a stretch movement, even though each day might have been a slow range and the Bollinger Band volatility might be low. Over a period of days it might offer opportunity. So there's not a one size fits all. There's a few tools you can use to your arsenal. The main one is your eyeball, but if you're screening for stuff and you want some sort of binary filter that allows you to trade it or not, then you've got the ATR, you've got the Bollinger Band width, you've got those other tools that you can potentially use. The point is, guys, giving you some there, the point is, have some kind of strategy that keeps you out of the chop, because chop will just chop you up, funnily enough. It will just ruin your account. And the last thing you want to do is to do all that hard work, growing your account, growing your equity curve, only to give it back because you've got involved in a choppy market. And it's just heartbreaking. So find a way of avoiding chop, eyeball or one of these indicators to act as a filter. Anyway, guys, take care. I shall see you in the next video. Thanks for watching. Bye bye.